Welcome to Cherry Street Investor Education with Kavita Baratake, passive income coach and founder of Cherry Street Investments. Education that is designed for you to take control of your financial life. Join us to learn how you can create multiple passive income streams, diversify your portfolio, save on your taxes, and much more. Become a better investor and fast track your financial goals. Here's your host, Kavita Baratake.
For those of you who don't know me, I'm Kavita Baratake. I'm here to talk about how to build wealth in real estate. My own story, I want to share a little bit of it as we move along. But before that, I want to talk about how to build wealth in real estate, and also talk a little bit about a few disclaimers here. I should always have that disclaimer side, and I don't know why it didn't go in. I do a lot of education here every 2 weeks. For those of you who don't know, we talk about real estate. We talk about different types of real estate. We talk about tax strategies. We talk about legal strategies, legal things that you should do to protect your wealth besides creating wealth, right? It's not enough to create, but you need to figure out how to protect. So today I have a full agenda here. We're going to talk about why invest in real estate. Before that, we'll talk about what a typical investor profile looks like that I see. I talk to a lot of investors day in and day out. That's my job. And I see a specific profile of investors that come to me wanting to invest in real estate. So we're going to talk about that profile. We're going to talk about stocks versus real estate a little bit, because I was in the stock market. I was a stock investor for a very long time. And to say I have moved away from that would be true, but to say I want to get back into it as well and I see the need for diversification is also true. So let's talk a little bit about what we're going to cover today and then jump right in. So why invest in real estate? Well, the different types of real estate. Most people know single family homes. That's where people think real estate. I'm going to buy a house, I'm going to rent it out, right? But there's just this whole set things in real estate which we don't know about, and it took me a while to learn this. So I want this to be kind of like a primer, if you will, for all things real estate. We'll talk a little bit about diversification. What is a syndication? Why bother with the syndication at all in your investing portfolio? What are some of the legal and return structures in a syndication? Who are the different types of investors? A lot of people call me, hey, I'm not an accredited investor. And we'll talk a little bit about who that person is. Can I still invest? Absolutely, yes. And we'll talk a little bit about that as well. We'll talk about equity growth and cash flow. And this has been coming up a lot for me lately, because a lot of folks are like so cash flow centric that they forget about growing the equity. And I think it's very important as an investor to think about where you are in your investing journey and focus a little bit more on one versus the other. And I'll talk about that a little bit more. And also cover my top 10 do's and don'ts investing philosophy, if you will, based on which I feel that it has really helped me grow my investment portfolio. I'm really trying to move to the next slide here. All right, a little bit about me. A lot of you folks know me. For those who are new here today, thank you guys for joining in. I am Kavita Baratake. I moved from Bangalore, India in 1998. I borrowed $3,500 from my sister and moved here to start college. I know a lot of you shared my story. You moved here with literally nothing, and that's a typical immigrant story here. Did my master's in computer science from A&M, followed that path. I grew up in Bangalore, which is software city, and it was inevitable that I end up in computer science, right? So did that, worked for IBM for about 15 years, and then another company called Atlassian for about 5, before I realized it's not what I'm passionate about. It's not what wakes me up in the morning. And along the way, I started investing in real estate around 2009. Like everybody else, I started in the single family world because that's the only thing I knew. And the market was trashed at the time. Nobody wanted to buy, and there were foreclosures everywhere. I bought my first house in Austin for $98,000. And remember, for those of you, some kids on here as well today. So you don't have to get all this money out of your pocket, right? With real estate, that's the beauty of it. Leverage is a beautiful thing. Embrace leverage. I levered and I took a loan for 75, 80% of it. And I only put down $10,000 or $20,000 for that house. And of course, there's nothing in Austin for $98,000, I promise, right now. But again, it's a success story, but people say, hey, real estate has done its time. I don't see any way to get in. I don't believe that. Again, I'll talk about why. There's always areas within any asset class, any kind of investment that is not looked at by people because people are scared. And that's where you want to get in. People were scared in 2009 about investing. Nobody wanted to pick up houses because there was so much uncertainty and fear in the market. It's always easy to look back and say, I should have, could have, would have, but it was very hard to pull the trigger unless you conquered your fear. And that's part of getting over that herd mentality when it comes to investing that really bodes success for any kind of investor, whether you're in stock market, real estate, any kind of investment, right? So anyway, I financially freed myself with real estate and transitioned to full-time real estate because people told me every time I talked real estate, my eyes lit up. They were like, you're in the wrong business. What are you doing? Anyway, so that's how it happened for me. And it has been pretty scary for the past few years going through COVID and transitioning from getting a paycheck every month, every 2 weeks into my bank account to not getting anything at all through COVID. But it's been a great, interesting journey from being an employed person to a self-employed entrepreneur. I do a lot of multifamily investments. For those of you who know me, I'm a passive investor myself. I invest heavily in all kinds of investment. And I'm proud to say I don't invest only in multifamily. I diversify my own investments, even within real estate. And also, I started Cherry Street Investments with a very simple goal. I found it really hard to access this information about real estate. Besides knowing single family homes, I had an uphill battle. I went to Dallas every weekend. I was trying to learn from a mentor there. I paid a bunch of money. And I felt when I really was done that it could have been much simpler. And that was my focus when I started. I said, how can I bring this education to the investors in their homes instead of them going out and seeking it, because you have a full-time job, you have kids, your family, you have all these things, and you have to prioritize learning somewhere about your investments, right? And it's very important for me for folks to learn about it. And someone asked, what's an LP? It's a limited partner. And I'll talk a little bit about that. It's just, it's in the future slides. So I help people invest passively in real estate, and we'll talk about what these passive investments are. I also have an insurance license. So I practice something called infinite banking or infinity banking. You can look that up. I'm also a realtor. So I'm a jack of all trades, but I focus heavily on passive investments in real estate, for those of you who know me. All right. Along the lines, please go to my channel, subscribe to my channel. It'll really help me. I have been trying to post a lot more of these webinars there. Every webinar that I've done is on here. Christian says, I'm a dancer too. Yes, I'm a salsa dancer too. Thank you, Christian. Christian is one of the better dancers in Austin. I'm not a good dancer. I just dance for fun. Christian is a professional. So anyway, coming back to Cherry Street Investor Education, every webinar I've ever done is on here. If I get any investor questions, I try to post it on here as a video, because a lot of investors ask very much the same questions over and over again. So try to kind of condense and make it like a repository of information for investors. So this is really close to my heart, and I don't know if you guys watch Tony Robbins. I know there are like haters and likers, but I truly believe that the secret to living is giving. And part of my education's always been about giving, whether it is to adults or to kids. I did a lot of kids education for those of you who are interested. It's on YouTube as well. It's called Money Wise Teens and Money Wise Kids. A friend of mine helped me for the little kids, and I mostly handle the teen education. So if you guys are interested, I plan to do that again this summer. So if you guys are interested, please look at that. I have a short message from my daughter here who's on. She wants to talk a little bit about Give for Good, her campaign for lymphoma and LLS. I forget the whole full form, and she'll explain it a little bit.
Hi, everyone. Thank you for your time. My name is Shania Gupta, and I am fundraising for the Leukemia and Lymphoma Society. So today, more than 1 million Americans are fighting blood cancer, and every 3 minutes, someone unknowingly joins the fight. So I have been nominated as a candidate in the 6th annual Students of the Year fundraising challenge, and all of the money fundraised from January 7th to February 26th will be going towards critical cancer research, patient services, and advocacy efforts aimed at improving accessibility to affordable cancer treatments. Now, World Cancer Day is coming up tomorrow, and in honor of World Cancer Day, we also have a 50-state challenge going on. So the candidate who is able to secure a donation from as many of the 50 states as possible can earn over $2,000 towards their campaign. So I'm here today to ask if anyone can make any amount of a donation, even a simple contribution worth a coffee. You can scan the QR code below to make a tax-deductible donation towards our cause. Once again, thank you for your time. Have a wonderful day.
I think she forgot to say some more things. So Anya lost one of her close classmates to cancer very recently last year. So this has been a cause that really drives her. And so she wanted to share this with you guys. Feel free to donate whatever you want. There's no minimum. So we really appreciate your donations to push things forward for cancer research. Everybody, I know has COVID, but so many people I know have cancer these days. It really breaks my heart. So I hope you guys can help this cause out, and I will move forward after this. Thank you, Anya, for being here. You can drop off now.
Thank you so much. Have a great day.
You can do the scan the code there if you're interested. I'll move forward here, and happy to share this again with the recording if you're interested. So let's talk a little bit about the snowball effect. I see a lot of people have a lot of FOMO when it comes to real estate or just investing in general. They feel like they missed the boat, right? A lot of folks feel like they missed the boat. And I feel like that's never true. You have to start somewhere. And this snowball effect is really, when I look back and I was charting my net worth growth over a period of time, it wasn't a straight line, right? It kind of curves up, and it just happens slowly over time. So you have to start somewhere, and you have to start small. And I would encourage you to start today, right? Focus on one step at a time, because you're not going to become, I don't know where you are in your net worth, but you're not going to get there in one day, but whatever your goal is, right? It's going to be one step at a time. And it's just going to be one thing at a time. So it's the hardest part is getting started, because once you gain the momentum, and I'll tell you with myself, when I bought that first house, I actually was trading stock options. I almost lost that money. I lost a lot of money in stock options. I made a lot of money as well. But when I was still positive, I pulled that $20,000 out and bought this house. And I didn't think much of it. I'm like, one house isn't going to change my trajectory. But what I didn't see is how that one house would allow me to go forward and buy more. And then eventually, after I bought enough, I felt like I couldn't handle it. I ended up in apartments. So it's a journey that you really cannot see the outcome of initially, but you just keep stepping one step at a time, right? And time is your friend. For those of you who are young out there, meet a lot of young investors. I'm like, time is on your side. Take advantage of it. Even if you're in your 40s, I know people in their 60s who've done really well right now. You still got 20 years. So don't worry about the time. You still got the time, and you want to celebrate the wins along the way as well, because there'll be some small wins, there'll be some big wins, there'll be no wins. I've learned that I need to enjoy the process as well, right? It's not just about the outcome, but if the process is not enjoyable, you're just not going to be successful in whatever you do. All right, let's go forward here. So I want to talk a little bit about this. This really spoke to me when I saw this before, and I have talked about this in my past webinars, but a lot of new folks on here. So Thank you guys again for joining in. I don't know where you are, but some of the world is really cold and nasty today. So I appreciate you joining in here. So where's your money, right? A lot of folks I see, right, this tier 4 is called a speculation tier, the stock market or crypto, whatever. You have absolutely no control over your money there. You're completely dependent on what's going on in the market. You can make your best guess, but the players who control the market are not you, right? And a lot of folks have a ton of money up here, but when it comes down to it, people don't have money at the lower tiers. And let's talk a little bit about the lower tiers, right? People have like kind of an upside down triangle, if you will, where 80–90% of the assets is in the speculation, and then they hardly have anything as far as direct investing concerned, whether it's buying a house, buying a property of some sort, investing in themselves. As far as savings and protection go, we're talking about, yes, people set aside some emergency savings, but if you look at life protection, for example, insurance, they rely on their employers 2 times your base income to actually protect their lives. And going through COVID, I've seen so many GoFundMe campaigns. It's not funny, right? People who are like you and me, who are in well-placed jobs, well-placed in society, just losing everything over medical bills, right? So I really think people need to rethink how they invest in terms of diversification and what they invest in, because a lot of people have this upside down triangle going on where the risk is super high. Yes, they are making money, but they're also losing money, and it takes time to recover what you've lost, right? And the control is really low. And as you get older, you want to stop thinking about diversifying across these tiers, whether it's rental homes, syndications, definitely have stocks and cryptos as well, but kind of diversify across the tiers. We have only learned about diversification within the stock market because Wall Street does an amazing job of promoting the stock market, right? Look at your investment account. There's nothing else you can invest in, right? Can you invest in real estate? No, not normally, right? But we do have ways for you to invest in real estate as well. So it's important to diversify across the various tiers and not just looking at diversification within a specific tier, whether that's the speculation tier or syndications even. You don't want to be over-invested in syndications. You want to look across the entire board, right? Look across the board and see where your money is. So stocks and real estate, yo-yo. I have done both, and here is where it shakes down. The liquidity is really high in stocks, which is great. You can sell at any time. You can get your cash back, unless your stock is in the dump, in which case you're losing money when you sell it, right? Real estate is really low. That is a concern. So you don't want to put all your money in non-liquid assets that you can't tap into it quickly. So you want to have some of your net worth in liquid assets, right? Whether it's stocks, whether it's life insurance policies, wherever you can access money quickly. Growth is high. Real estate tends to be more moderate, although I think the syndications that do actually produce pretty high returns for the longer term, although you're not going to see these, oh, Tesla went up 20% in one day, right? You're not going to get that because that 20% upside is also kind of mirrored by the downside. So the volatility is very high. So you have this yo-yo thing going on in the stock market. You have no control over it. So how much of your wealth is in it? 80% in most people's cases. Is that where you can sleep well at night? I don't think so. I didn't sleep well. In 2008, my 401k was half what it was in 2007, right? So I didn't sleep well at night at all. So I realized that that's never going to be the case in my life again, where entire 401k is sitting in the stock market. Anyway, the volatility on the real estate side is very low. You have a steady eddy kind of situation. It keeps going. It's not crazy high, crazy lows. We also get a pretty good indicator of where the economy is going. So it doesn't hit real estate quickly, right? Stock market, it's like one day it's down, right? In real estate, it takes months before we can get there. It can definitely get there. The fees are very high in the stock market, and fees eat into the returns. The fees are moderate on real estate, and I'll talk a little bit about how we invest and what kind of fees we charge. The risk is high. I think, in the stock market. Real estate is moderate. Leverage, you can buy on margin in stocks, or I don't know a lot of non-savvy investors who actually buy on margin. So basically taking somebody else's money. Here, we truly have the ability to leverage 75 to 80% of the price that we pay for a property, which is a great position to be because we're getting cheap leverage. Leverage has been cheap, right? We're getting 2% loans, 3% loans, 4% loans. Great, still low, even with the interest rates going up, still historically low, right? Cash flow, it's possible with dividend stocks and ETFs, but most of the stocks, you're just hoping that you'll make money on the stock itself, right? It's not necessarily generating cash flow unless you invest in specific kinds of stocks and ETFs. Cash flow assets in real estate provide steady income, especially if you have an asset that is generating cash flow, like a multifamily apartment or whatever. Taxation, this is the biggest thing, guys. Taxation. A lot of people don't see money going away in taxes until they actually compound. Look at the effect of taxes on compounding. There are no tax benefits in the stock market. You're not going to get anything. But real estate, there's so many tax benefits that pretty much any cash flow that you'll get in real estate will be tax deferred, in the sense that you're not paying taxes while you hold it because the depreciation on these assets is so high. So when you look at the average stock market returns, I know we talk about the high returns which are possible with this individual stocks that you can make, like, I don't know, 100, 200%. People have made good money in the stock market. I'm never going to ding that, right? But if you look at an average long-term portfolio of an investor in the stock market, they might make about 8 to 10%, right, before taxes. But now you remove taxes from there, you're down to 6 to 8%. Even if it's a retirement account, remember, it's just tax deferred. You're still going to pay taxes at some point. With real estate, we're looking at 12 to 15% for multifamily stabilized real estate investments, 20 to 25%, huge return on investment for land and new construction. Those are the average returns we are producing right now. So the high returns are possible in certain markets. Of course, they come with risks, but there is no such thing as a free lunch. High returns, high risk. But real estate is something I feel very comfortable in because there is a tangible asset that you're investing into. So why invest in real estate? Like I mentioned, it generates cash flow and equity growth, right? It can be just equity growth and no cash flow. For example, we do a lot of these land deals. There's no real cash flow there, but there's a lot of equity growth. Real estate provides very low volatility compared to stocks, crypto, and other investments. So you're just not going all over the place quickly, right? It takes time to get there. We are backed by a tangible asset, ability to add value to provide higher yields. And we'll talk a little bit about this whole concept of adding value to real estate. We're not just going to buy real estate to hold on and hope for the real estate values to go up, right? We actually actively go in there and try to do things to add value to that investment. Supports portfolio diversification. A lot of people, like I said, are over-invested in the stock market. Here's a way for you to diversify and put it outside of the stock market. Provides tax advantages from depreciation. Spoke about this in a second ago. Generational wealth. A lot of people, if you look at the richest of the rich in the country today, they look at generational wealth. They are not looking at just creating money for themselves to retire, right? They're looking at what am I going to pass on to their children, to my children. So real estate is truly the only way for you to pass on generational wealth to your children with tax deferral strategies like 1031 exchanges. So most of us probably not thinking about it, but there is taxes for estates when it passes on to children. So real estate is one of the few ways that you can avoid those kinds of taxes. And that's a subject we can cover entirely and talk about tax strategies. But there is a lot of tax benefits, which is why the rich people always in real estate, right? And This is another one a lot of people probably don't know about, and you should know about, is something called opportunity zone funds. You can Google it, you can look at it. I've also done a webinar on opportunity zone funds. It actually allows you to grow your money tax-free. So let's say you made money in the stock market and you pulled out that money, you have capital gains, right, that you have to pay taxes on. So there are ways in which you can defer those taxes, also not just defer the taxes, but also grow the money tax-free in an opportunity zone fund. If you're not aware of this, if you're a stock trader, crypto trader, any kind of a capital gains event qualifies for an opportunity zone fund. You should definitely look into this. So a lot of folks know about residential real estate. That's where they are. Single family, maybe duplex, quadplex, something like that. But there's a whole world of investments out there, right? There's commercial, office space, retail investments. You're talking about, let's say, HEB, where you go to your neighborhood grocery store. You're talking about that kind of retail. That's this big box chain retail. There's also small retails. There's apartments, there's senior living, there's self-storage, there's medical offices, industrial factories and warehouses. Special purpose. We have mixed use where you live upstairs, you have all these retail downstairs. We have raw land, farmland, schools, churches, government buildings. It is possible for you to invest in all of these different kinds of investments besides single family and small multifamily without having the big dollars, right? It's quite possible. And that's what we'll talk a little bit about. Like, why do commercial? Why get into that space at all? So when you look at residential, you're talking about 1 to 4 units usually, small scale. Capital is low and affordable. Cash flow is low, but you don't have resiliency. So let's say you have this one tenant and the tenant leaves. It's a 1 or a 0 game, right? You don't have any money coming in if the tenant leaves. Your value is also based on what the other homes are selling for, which is we call the comps or comparable sales, right? And the scale, because you're buying only one unit, you're paying the highest cost per unit. A single family home is going to be your highest cost per unit. Your management costs are also going to be high, 8 to 10% on an average if you hire a management company to manage your rental. Your rehab cost is high because you're paying retail for everything. High labor, material cost has gone up, labor cost has gone up, name it, it's true right now, right? Loans, you have conventional FHA, BA loans, but they're called recourse loans because they depend on you and your credit to qualify for this loan, right? They're looking at your debt to income ratio to qualify for a loan on a residential side. On the commercial side, very different, right? Large scale, capital outlay is large, but we don't need one person to bring in the capital. We pool the capital, right? We have a lot more higher cash flow, more resiliency in the asset, because let's say I have an apartment building, I have 100 tenants or 300 tenants, depending on how many units I have. I can afford for 10, 20, 30 to be out, right? And not paying, whatever else. But I can't afford that when I'm a small operator with 1 or 2 single family homes. I am still recovering from COVID, and I realize my throat is not really up to par, but I'm going to keep going. So the value is in a commercial building is based on what we call the net operating income, not on sales comps. It doesn't matter. Sales comps matter to a certain extent, and that the cap rate of that. We'll talk a little bit about cap rate. I know I'm throwing some terms at you guys if you're new to real estate. It matters in the sense the market has a specific cap rate for that kind of a property, it matters, but your income from the property, if you can push up that income, the value of that goes up. So the value is based on the income of the property. The scale also lends itself to lower costs per unit. The management costs are lower. You have rehab costs, which are lower because now you have scale. If I'm renovating 100 units versus 1 unit, guess what? I'm going to get a better deal on all the materials. I'm going to get a better deal on the labor. It's just going to be an overall better deal, right? The loans in commercial are non-recourse usually, which means you don't put your personal guarantee or personal credit online. It is, in case of land, it is usually a recourse loan, but in case of multifamily, it's a non-recourse loan. The property itself becomes the creditor, And we as buyers do have to show liquidity and net worth, but we don't have to worry about debt to income ratios. So I qualify for commercial loans. I can't even buy a residential loan without a job. So that's kind of where it is. So let's talk a little bit about real estate investing 101. What's a cap rate? A lot of folks get hung up on this really quickly. It's really the potential of a property or investment to generate, like what it generates. So assuming that, I don't know, a part of it is cut off, I'm sorry about that on the right side, but assuming that you're, let's say, buying all cash, right? Like the value of a property, $1 million, you're buying all cash. And that property produces a net operating income, which is income minus expenses, is called the NOI. That generates a $100,000 NOI, right? You're talking about a 10 cap. That's what it's called. It's a NOI divided by value times 100. So the cap rate is really, it's the yield of the property over a 1-year horizon, assuming that you buy it all cash, which we don't ever do, right? We leverage, we actually go get a loan out for 75% of the value and we're putting 25% down, let's say. So your cap rate actually, the actual income for the property goes up. If you can get a better cap, then let's say you buy it at a 5 cap, but your interest rates on your mortgage is at 3%, then you're actually realizing the difference between the two as well. So without getting into too many details here, what you need to understand about a cap rate is if someone comes to Austin and buys a property, there's very high demand. It's very low risk in a high demand situation for someone to own a property, right? So the cap rates will go down. So cap rates down means that you're paying a huge price for the same property. So Austin is trading at a 2 cap, 3 cap, maybe 4 cap. You'll be hard pressed to find 4 cap properties, which means it's generating $40,000 for $1 million investment right now. That's kind of where it is, $30,000 for $1 million investment, which is not a lot of money really. So the lower supply leads to higher demand, leads to lower cap, because investors are willing to get lower yields in good markets, especially something like Austin, right? And we'll talk about what forced appreciation is. So let's say you bought a property and now you want to increase the value of the property. In a single family home, you can go rehab the home and look at comps, but your value is limited by what the comps are selling for, right? Here, your value is limited by what your income on the property is. So you can increase the income on the property, you can decrease the expenses on the property, or you can do both, right? So you can really control the value of the property with this concept of forced appreciation. So let's say I bought a 20-unit property for $1 million. The rent is $1,000 a month per door, which means per unit, and you make $20K a month, which is $240K a year. Now let's assume that the expenses are $140K, right? You have property taxes, you have insurance, you have repairs and maintenance, which is R&M, and property management. So your NOI, or net operating income, is income minus expenses, which is 100K in this case, 240 minus expenses of 140K, right? So if you bought that property for $1 million, then your purchase cap will be a 10 cap, right? Now let's look at what happens if we increase rental income. Let's say I increase the income by $50 a door. So it's 50 times 20 units times 12, which is 12 months of the year, right? So we have $12,000 per year that you increase the rental income by. Now you did this by the $50 a door by just doing $25 each year over 2 years, right? Not a big increase. We also reduce expenses, 8,000, by telling, hey, I was paying for the electricity, I was paying for the water, now let the tenants pay for the water, right? So effectively you increased income by 12,000, reduced expenses by 8,000. So effectively you have $10,000 more per year on the property, right? Plus 12 minus 8. So your net effective NOI now is 120K, right? Earlier you had 100K, you made $20,000 more, sorry. It's 12 plus 8, right? $20,000 more. So now your new value of the property is NOI divided by the cap rate, which is, let's say it still stays the same, the cap rate, 10 cap, right? So it's $1.2 million. So assuming that cap rate at sale is 10%, you've added $200,000 in value for $1 million property with just 20K increase in NOI. So for a 10 million apartment building, let's say you scale this up, you can achieve a $2 million raise, even if the market did nothing, the market didn't appreciate. This is called forced depreciation, where you increase the income of the property in the same market conditions to get even more. Now, assume that you're in Austin where it's trading at 3 cap. Now your value is going to be even higher. So now combine this with a market where the market caps are going down, which means the market is getting more competitive. You can achieve even a bigger increase in your value, even if everything else remained the same. So let's say you increased the NOI and the market appreciated on top of it, you can get much bigger increases. So what's depreciation? We talked about appreciation. People talk about depreciation. So depreciation is essentially a good thing as a real estate investor because it allows you to take the structure value of the investment and actually get is as a paper loss or loss that you actually didn't get a loss, but it's allowed because now you're taking this asset. Let's say you built a house. Over a period of time, the things within the house are getting older, right? They're losing their value in the sense of the appliances are going to go out in 5 years. The roof needs to be replaced in 10 years, whatever that is. So there is a depreciating asset in that even though the value of the land and everything else appreciates, the asset itself depreciates, right? So in a straight line depreciation, the residential asset. So let's say you take the structure value, which is the property minus land. Land doesn't depreciate, right? It's just a piece of land. Nothing can go wrong with it. It can go up in value, but it cannot be depreciated. It doesn't have a useful life. Its useful life is forever, right? So normally you depreciate over 27 and a half years. You take the total value, remove the land value, and then divide that by 27 and a half, and that is your depreciation every year. So let's say you bought this real estate investment and you were making $5,000 a year, right? You can actually take this off your $5,000 of income after all expenses as a negative, as a loss, which is 45. So it really saves you taxes even though you made your money, right? Now in commercial assets, it's even amplified because it is depreciated over 39 years, but we have these other tools that we use called cost segregation and bonus depreciation. And I'll talk a little bit about it without getting into too much detail and confusing people. It allows you to take even a bigger depreciation on your asset very quickly. So what's cost segregation? Very simply, let's say I own a house. It can be done on a house, it can be done on an apartment, it can be done on any real property, right? So let's say I own a house or I own an apartment. I take the roof and I say, oh, the roof lifespan is 10 years. Appliances, 5 years. Flooring, 10 years. Fixtures, 5 years. So the components of a building, and this is something a cost segregation company has to do. You can't do it, right? You have to call someone in, they will do a cost segregation of the building for you. And this is especially useful for those of you who are looking at Airbnbs, because now you not only have fixtures and all of this, but you also have furnishings. You furnish the whole place. You can cost seg and depreciate it and take a big chunk of income off your W-2 income. Yes, I said that. W-2 income, provided you spent 100 hours in real estate, material participation in your short-term activity. And we can talk about that offline if you're interested. But essentially, you break that down into 5, 7, 10, 15-year schedules. The cost center company will do that for you. And bonus depreciation it's something that's going to get phased out soon. But for now, It allows everything that is depreciated over 15 years or less, 5, 7, 10, 15, in 1 year. So just to give you an idea, let's say you do a typical investment with me or anybody else who does these real estate investments. Let's say you put in $100,000, you're taking about a negative loss on paper, right? Not a real loss, about $60,000 to $70,000, maybe even $98,000 on some of these investments. This is how powerful it is in offsetting income, right? So let's talk a little bit about syndication. Why invest in a syndication? What is a syndicate first? So we are looking at saying, okay, I'm going to buy a 300 unit apartment. Can I do that alone? Yeah, I could. Maybe if I was Jeff Bezos or Bill Gates, I could do it alone. But most of us can go buy a 300 unit apartment for 30 million, right? We look at getting a pool of investors together, we pool resources together, we share in both the risks and the potentials for the returns. What are the benefits? You have a broader investment choice. And remember, I showed you that realm of real estate, which is really large. You can expand beyond those residential investments. There's no reason to just invest in a single family home or a duplex or a quadplex, right? You can invest in anything you want, industrial included, factories, anything really, and even things like ATM machines and energy investments. So that was truly an aha moment for me when I was learning about investments, is that I was looking at such a small portion of real estate that I didn't really know about this bigger. It's become pretty common nowadays, but when I started out, it wasn't, right? So the other advantage it provides is it's truly a passive activity. How many folks, you want to raise your hands, raise your hands, how many folks own a single family home and manage it, or at least have tried to manage it? All right. Great experience, okay experience, won't do it again? I want to hear some feedback here. SEMA says 500 hours, not 100. It's 100 material participation hours for short-term rentals, as far as I know. So you guys can consult with your CPA. All right. So anyway, for those of you who have invested in single-family homes and have had the pleasure of managing single-family homes, it's not fun, right? It's not truly a passive activity. As much as I love my rentals, it's not a passive activity. I hired a manager, they called me for everything. So I did not really want to be in that situation. And what I'm trying to do, even though I actively sponsor these syndications, I am actually creating my passive investment profile and making it larger each day. At some point, I want to step away from all this and have a truly passive investment, right? But right now I'm young and I enjoy doing this, so I'm doing it. Economies of scale, right? We talked a little bit about that. You have one unit, you have 2, 3, 4. You don't have the economies of scale. You benefit from a lower overhead on these larger properties, whether you're doing retail, commercial, of any sort, it doesn't really matter. There is that economies of scale, which helps you. So there were some questions around who's a general partner, who's a limited partner or LP, and we'll talk a little bit about it. A general partner, so think about it this way. If you were to go buy a single family home, do all the legwork, go meet agents, go look at houses, all of that stuff is taken away from you, right? You are only the source of money. You're like a bank, but you get to share in the upside of the property as well, unlike a bank, where if, let's say, I'm lending money as a debt investor, I don't get to share the upside, right? I get to share only in a fixed percentage that you've allocated to me. Here, you can do both. So who's a general partner? We do the underwriting. Underwriting is just a fancy term for financial analysis of the asset. We put out a 5-year, here is what the asset will do in 5 years. So we think, again, we don't know what the future holds. We can just do our best guess based on how the past has been. So we acquire the asset, we manage relationships with brokers and lenders and investors. We work with attorneys because all this has to be done with legal structures and syndications are regulated to be done a certain way. We can't just go willy-nilly and connect money from people, right? We have to work, we work usually with third party or in-house property management companies to manage this asset on an ongoing basis. We provide monthly reports or maybe quarterly reports in case of land. Usually there isn't a whole lot to report on land monthly, right? When we buy a piece of land. We do distributions monthly or quarterly on assets that produce cash, like apartment buildings. And then we also track the execution of a business plan. And this is really important when you're investing, is to look at what the business plan for the property is. When you buy something, you have a business, you need to have a business plan. Your business plan cannot be, I'm just going to hold and pray that this property will increase in value. That's a very poor business plan, right? You need to have a solid business plan of how you're going to add value. What are you going to do? What's your entry? What's your exit, right? We also sell the asset for you. We disperse all the investment funds. Who are you? You are a limited partner. Let's say you come in with a cash investment. You come in as a partner. So you get something called a K1 for tax purposes as a partner twice there. Sorry about that. May receive cash and cash distributions. Again, if you have an existing asset, you'll get monthly or quarterly distributions from us. You receive reports on the property. We have done this new thing where we don't necessarily share the upside. Some people just want a lot of cash flow, right? Say you want 10%, 12% cash flow. We have that option, but you don't get to participate in the increase in value in the property, right? With no upside. We call them like our debt investors. Equity investors get a little less, let's say 8% cash flow, but they share the appreciation of the property. And both sets of investors can get depreciation. So like I mentioned, the returns and syndications are cash on cash as well as equity returns. Now, it can be that you don't have any cash on cash. If I buy a piece of land or if I'm building a new construction project, there is no cash for a while, right? But you are looking at the long-term returns on the project and saying, usually to make up for the lack of cash on cash returns, we usually give better returns on land and new construction than you might get in an apartment building, existing building with cash flow. Folks ask, are there risks here? Of course. Let's say you went and bought a property tomorrow and the tenant stopped paying, or something went wrong where the tenant left and you couldn't find another tenant. Your cash flow is going to be affected. Ours less so because we have more units, but it can still be impacted. So every quarter or every month, we look at our cash flow and say, okay, this is a good month, we can distribute. In some cases, we can withhold, but even if we withhold the cash flow, it accrues, meaning you will get that paid on the back end when we sell or we refinance or do something like that. Let's talk quickly about the return structures in a syndication. You have preferred return. Usually, preferred return means that, let's say I tell you, I'm going to pay you 8% preferred return. What that means is 100% of that 8% comes right back to you first before I get paid, right? 100% of whatever that preferred return amount is. After that, we might split. That's how I get paid, right? When I'm working, is that 100% of the first preferred return, let's say it was 8%, then 100% goes to the investors, then we get paid. There is another model where it's called a straight split model, where people just agree to get 80-20 split. 80% goes to the investors, 20% of all profits go to the sponsor. So there's no preferred return. I prefer the preferred return model because it allows the investors to realize the full potential of the investment, which means they get paid before the sponsor gets paid. So it really gives an incentive to the sponsor to produce more than that 8%, because that's the only way we get paid, right? So the equity returns, similar to the cash flow, there's also splits of the equity. So let's say On the back end, we sell the property, we might split 70% to investors and 30% to us, or 50-50 or 15-85. It could be any way, depending on what your preferred return was. So let's say in land, I give you 18 preferred return, 18% return, then maybe the splits are more favorable for the sponsors or the general partners, okay? There's something else called a hurdle, and not to get too deep into this, but if, let's say, you achieve a specific return goal, then the returns, the splits might change from that return goal. So for example, if I meet the 13% return, then the splits might change from 30 to 70-30 to 50-50. So it can be structured a lot of different ways, but these are just few of the ways it can be structured. And the legal structure of a syndication is limited partners. We have an LLC. The limited partners come in as a specific class of the LLC. The general partners come in as a different class in the LLC. And then the LLC invests in the property. All right. These are things that I have to go through, but I have something for the end, and I hope you'll stick around. I want to share some of my investing do's and don'ts and talk a little bit about where you should look for opportunity. I know that everybody thinks, oh, real estate is dried out, it's too high right now, but there are opportunities in real estate that you don't really see, and that's kind of where I want to talk about. Just stick around through the boring stuff, but necessary stuff sometimes, so we'll get to the more exciting stuff. So who's an accredited investor? People ask a lot, do I have to be accredited to invest? Absolutely not. The accreditation is only required for certain types of investments. So accredited investors, really in short, someone who either has certain income capacity or certain net worth capacity. And it can be an LLC as well. It doesn't have to be a person, it can be an entity also. So without getting into more details here, you can read through these slides and I'll share them with you as well. If you are not an accredited investor, you are a sophisticated investor. What does that mean? You know what you're doing. You're learning about this investment, you evaluated the investment, and you know what the risks and merits are. There are no income requirements here, but we can only do this investment for 35 people who are sophisticated in a given investment, right? So let's talk a little bit about types of syndication. This is important from the point of view of accredited versus non-accredited. We do both of these kinds of investments. It's called a 506B or a 506C. It's simply a way for us to structure a syndication. Reg D offers some kind of exemption with SEC. If you guys are interested, you can go research that further. It's essentially we're filing an exemption with Securities and Exchange Commission, and that's what the Reg D is. And the types of investors allowed in these two syndications are different. So when we do a B syndication, we allow for both accredited and sophisticated, but only up to 35 sophisticated. Here, we allow only accredited investors. What does that mean from an investor solicitation perspective? We have to have a substantive relationship, which means it has to be existing before the property between me or whichever sponsor you're working with and the investor. Or you can have a referral of current investors. So let's say you're an investor, you referred your friend to me, that's allowed. But I cannot generally go solicit that investment on social media or just send an email to someone I don't know, right? So C, on the other hand, we don't need any kind of prior relationship. I can go on Facebook, social media, public platforms and post about it. Sorry, I need to go back there. This is important. You don't need to do accreditation verification for the B syndications, whereas here we need a third party to verify that you are accredited. So usually it's online, verify investor, CPA, attorney, or financial advisor. Again, we do both kinds of syndications. There's nothing shutting you out from one versus the other. Let's talk a little bit about different kinds of syndicated investments. So I spoke a little bit about forced appreciation, where you add value. You take an existing apartment building or an existing asset, you upgrade the units, increase the rent, reduce the expenses, all of that stuff. That's called the value add play, right? You add value. Yield play, if I buy a property as is and it's doing well, it's making money, I just hold it and take money from it. It's still possible. You know, a lot of people say, oh, there's no yield in assets anymore. Go to medical offices, look at other assets that produce good yield, right? If you look at Dollar General and assets like that, they still produce pretty good income. So you can just buy and hold them. We have hybrid. We take advantage of doing some value add, but already the cash flow is good and in place. We talk about new builds. I work a lot on these. It's called built for rent. So we build these communities, which are like apartment communities, but it's a set of single family homes, but there's like 90 of them, and we operate them like an apartment building. It's called built for rent. We could build to sell. Some of you are in investments where you build, we are building, and you will be buying a unit from us. We have low maintenance with new builds, no low cash flow during construction, but the upside is much higher on new builds. We have land banking. Here we buy and hold land. We purely bank for appreciation. You better want to get land in a great location if you're doing land banking, because here you're just praying for the market to go up, right? And if that doesn't, for any reason, you have basically no cash flow, no equity growth. Maybe high equity growth, but we won't know that until you realize and sell the property. A lot of you folks want to buy in Austin. Here's my 2 cents, right? When you buy into Austin, you're buying into a property that is not making any money for you. You're purely banking on appreciation. There's no guarantee of appreciation, right? We have seen the market appreciate. I don't know how much more it'll appreciate. So when people ask me, hey, should I buy in Austin? I'm like, here's my 2 cents. I actually have a video on buying in Austin. I've been in Austin 21 years. Austin and similar markets, right? People actually, it's funny how it works. People want to kind of buy at the high because they're afraid of missing out. I call it the FOMO. People don't buy at low, right? They're scared to get in. But when it's on a super high is when people want to get in. And unfortunately, that's the wrong time to get in, right? So we talk about land development here, which is different from land banking, where I don't buy and hold thinking that, oh, the land's just going to appreciate. I'm going to wait and pray that it happens. Instead, we buy land. We actually go through a process of entitlement, which means that raw land now goes from raw land to buildable land, like land on which I can do something, right? Entitlement increases the dollar per square foot of the land, the value. So you're really adding value. So this is my favorite strategy, is to take any asset and add value to that asset and not just hope for the market to do its thing. If the market does its thing, it's a bonus. That's not what you're banking on, right? And we also go in and do roads and utilities to add further value. It's called horizontal development. Maybe we'll go and do vertical development. We'll actually build something. That's when the structure comes up, right? So land has its phases. And right now, I actually honestly love land from a perspective of adding instant equity to that land. So this is very important. And I talk to a lot of investors about equity and cash flow, because I started in the cash flow world. I started investing in multifamily and single family homes when there was cash flow, and really took me a little bit to switch around and say, do I want to just invest for equity growth? Yes and no. I was in a battle there, right? But what I've realized lately is that there is room for both in people's profile, in people's portfolio, depending on where you are in your investing journey, what your goals are. So I talk a lot about this to my investors, where yes, there's high equity growth real estate, there's low cash flow. I mean, cash flow real estate, when you buy an apartment building, you can't generate a whole lot of money at the prices that we're buying things for right now. And that's the reality of the situation going forward. As the interest rates go up, it's just going to become unaffordable and impossible to generate returns, right? That's when you really want to start looking at other assets and say, where can I put my money that it can work for me? And this is where I feel like there is equity growth in new builds and land development, which is why I pivoted into those. The whole period in equity growth investments are typically shorter, 1 to 3 years, but you move your money and you create that velocity of your money is much higher than if you buy something longer term. So real estate generally tends to be a slower growth vehicle, right? You're not looking at stock market or crypto where it's crazy high and low. But even within real estate, you can focus more on equity growth rather than cash flow, worrying about cash flow, because it is possible in certain kinds of assets. So you're worrying about rapid equity growth, maybe no cash flow, but the question is, let's say you have full-time job. Who's the strategy for? You are a young investor. You're just starting your portfolio, or you are a full-time, you have full-time job. You have a lot of income. Do you really need the cash flow, right? So you're going to look at how can I increase the size of my pot so I can do more investments. It's all about the snowball effect, remember? So the investment risk can be high in these kind of equity growth investments, but it can be mitigated because the equity growth, on the other hand, here, it's not that apartments don't have equity growth. They have had, but I don't see them continuing to have in the same rate because you're already buying high. They say you make money in real estate when you buy, right? Not when you sell, when you buy, because you've already gotten into an asset that has increased in value since you bought. That's when you make money in real estate. So investment risk here is low because you're cash flowing, you have a cash flowing asset. But if you can mitigate the risks on high equity growth investments, there's nothing like it, right? So older investors, like if you are looking at retirement or you want to just boost income, yes, you do need the cash flow, right? You look at those kinds of investments. So I think there's room in your portfolio for both. You just have to figure out what the allocation will be in each category. So let's say you have a retirement account, right? I have my own retirement account. I put them in apartments, but on second thought, now I'm pushing all of them into high equity growth investment. I'm technically retired, but I'm not, because I'm not going to tap into my retirement account till I'm 59 and a half. I can't, right? So why don't I let that snowball effect in my retirement account get quicker with investing in high equity growth vehicles? I don't need the cash flow in a retirement account, right? I don't need the depreciation. These equity growth investments like land have no depreciation. You cannot get land. You cannot depreciate land. But why do I need the depreciation in a retirement account, right? It's just sitting there. There's no tax benefit to getting depreciation there. So that's ideal for retirement accounts. Whereas when you have your savings, maybe you want to generate more income. Maybe you want the depreciation so you can get the tax breaks. All right. Let's talk about the other considerations. People talk about money. I don't have money, or I'm not investing. I don't know what to invest in. My retirement is sitting in Vanguard or Fidelity. Can you invest into real estate? Absolutely, yes. Whenever you switch jobs is when you want to try to invest in real estate with your old retirement account, because your current employer is not going to let you use your retirement account for investing. So you can invest as cash, no problems there. You can invest using what's called a self-directed IRA. Now, you cannot take your Vanguard IRA and directly invest. You cannot take your Fidelity IRA and directly invest, or Betterment IRA, or any of those IRAs, but you can move those dollars into a self-directed IRA, and then that can be used for investment. You can create a solo 401k. Again, what is that? If you have a business, this is really great. This is the best way to invest, is to roll over your funds. Like I moved all my old employer funds into my solo 401k and I invest through it. So it's really important. And there is something called UBIT, and we can talk a little bit about that. It's some kind of taxes that come into play with self-directed IRAs. So I would like the investors to avoid self-directed IRAs, but it's not a deal breaker by any means. So what are the legal documents? We have a lot of legal documents will be thrown at you when you invest in a syndication. So you should get familiar with it. I have a whole video dedicated to legal documents with an attorney. It's called Syndication Legalese Demystified. You should look at that. We talk about what a private placement memorandum is, where we disclose everything about the deal. And people get scared here. They're like, oh, all the ways that the deal can go wrong. But we are required by law to specify those things, right? We talk about the operating agreement. What are the procedures that we operate this particular property, right? Who are the partners? What are their roles and responsibilities? All of that stuff. Investor legally commits using a subscription agreement. We ask about what kind of investor are you? And this is really important. What is our business plan? Like I said, if there's no plan, there's nothing. I would never invest in something where there's no business plan. What has the sponsor done before? What are their returns? What are the planned improvements? How long are they holding? What is this market about? You want to know all these things before you invest in anything. It doesn't matter real estate or not. A lot of us don't do the research, and that's really important. All right, here we come to the tips. I'm going to share some tips I have from my personal experience, and let's look at the do's, right? What you should do, I think. First thing is education. You're here today. I appreciate you putting in your time. Knowledge is the first thing. So when I started investing, I learned everything I could about stock options. I learned everything I could about real estate, and it's an ongoing process. It's never over. They say you need 10,000 hours to be an expert in something. So I think you can start with an hour a week or 2 hours a week of educating yourself in whatever you're interested in investing. It doesn't matter if it's stocks, real estate, whatever else. Definitely put in the time, because I promise you, when you do put in the time, you will learn and you will get better at it. Have goals, right? A lot of people are like, I just want to invest in real estate. Like, how much? How much of your assets should be in real estate? What kind of returns do you want? Do you want equity growth? Are you after cash flow? How much of each? Know what you are as an investor. Know your goals as an investor. Be in tune with your risk-taking abilities. I have people who are not good risk takers. Everybody's different. I'm a risk taker. Someone else might not be. So you need to understand if you're not a risk taker. So let's say you want to invest in real estate, but you want control. You're better off buying a house, right? You don't want to do a passive investment when you're not a risk taker and you can't trust other people. So people, when you're investing in a syndication, especially, this is true, but this is true, it doesn't matter what you do, whether you're investing in an ETF or whether you're investing in real estate, you're really investing in the people who manage these things, right? So you want to make sure you can trust them. They have integrity, they have the experience to do this job. You're also looking at location, especially when it comes to real estate. There's nothing else which will beat it, right? You want to look at who's managing the investment, where is that investment located? Those are top two things you cannot. I mean, it's so easy living in the world today to go do a Google map search and look at the location, look what's around it, read what's going on in this location, why is it so hot, whatever it is, right? Validate what me or anybody else tells you. It doesn't matter. Take it with a grain of salt. Go do your own research. Demographics. This is a big one for me, right? Right now, I'm letting demographics guide a lot of what I invest in. Is investments grow where people go. So let's say, look at it in the next 20 years. Where are people going? What locations are they going? They're coming to Austin, they're coming to Texas, they're going to Florida, they're going to Arizona. See how these markets have grown, right? In terms of asset classes, yes, people need a home to live. Multifamily is going to continue to grow, but there'll be a little setback when the interest rates go up, right? I'm completely and normally anticipating that there'll be a correction, but don't let that scare you, because think about it this way. How many people are getting old every day? 65 over in the US. Demographics, right? That huge population of old people in the US today. Where's that money going to go? Is senior living a good place? Perhaps. So look at people and let it guide where your investments need to go. Look at where people are going. Money just follows people. Patience. I found that this is a hard one for me, but I really needed this, and I think I've become much better about it. A lot of people, instead of buying low and selling high, they buy high and sell low, unfortunately, because they panic. They hit the panic button and they were like, oh my God, I'm going to lose money, right? But patience is definitely what rewards the people who stay in the long haul. Like when I was buying properties, people were selling properties. These were wholesalers. They sold properties for cheap, right? They never thought about holding it long term. They just wanted to make a quick buck. Yes, they made that quick buck, but guess what? If I look at the last 10 years, I think I made more bucks than the quick bucks that came in, right? So quick buck is good. Take your wins, but be a long hauler. Have a long-term outlook on investments, because I really feel like that's what will reward you. You can take some short-term wins. No, nothing wrong with that. Take it off the table, but have a long-term outlook, because I feel like if you think long-term in any investment, stock market, real estate, crypto, it doesn't matter, whatever, you ignore the short-term craziness of the investment, right? You don't worry about it because you are in it for the long haul. Hey, I'm going to stick around for the long haul. I go buy crypto when it gets trashed. I do, because I am a long-term investor. I'm just going to hold it, and someday it'll be fine. I'm not going to worry about the craziness in between, right? Opportunities. I love the Warren Buffett quote where he says, you get greedy when others get foolish, fearful, and then you get fearful when others get greedy. And right now, when people start getting greedy about investing in certain markets, that's when I get fearful, right? I am investing in Austin, but very select and very good locations, because I am not messing with the market that's on a high right now, right? So definitely get greedy when people are fearful of certain things. And I'll talk about few asset classes that you should get greedy on soon, right? Stay engaged. A lot of people make this financial planning a once in a, I don't know, year activity, but you really need like monthly focus, block a day, plan and track and spend time on your finances, stay engaged, ongoing. You can't delegate that to a financial advisor. I feel like nobody will ever care about your money. Even if you have an advisor, use them as an advisor, but make your own decisions. Let them be informed, right? Don'ts. I know a lot of people who will come say, hey, this person offered this number, right? Don't get hung up on the numbers. These numbers are just numbers, right? I can throw a number at you. It's different what the property performs, and we want to be close, but I take numbers with a grain of salt. I invest in people. I invest in locations. I don't invest in numbers. Numbers are feel good, but they're not really, I don't get hung up on numbers. I just want to make my money, make good money, but I'm not stuck on numbers. Diversify. I realize this personally. I am over invested in real estate, 100% over invested. 95% of my assets are in real estate. I am diversified within real estate across different kind of assets, but within outside of real estate, I don't have much, right? So I do intend to fully diversify now back this way, which is much easier to do, especially in a market like this where I can pick up stocks and crypto now. But don't put all your eggs in one basket, whether it's real estate or anything else. Make sure you have diversification even within real estate. And we'll talk about all the different asset classes a little bit next slide, I think. And don't invest for appreciation. Again, I keep saying this, don't invest in a market that is appreciated and just wait for more appreciation. You don't know if it's coming, right? You could, like the last few years in Austin, it's still gone up, but I don't know that it will unless you're looking at the long term, like 20-year horizon, sure. But if you're looking at a short term, if there is a correction, you don't want to get in, right? Value add, don't invest and pray. Look for opportunities to add value, whether it's renovating something or you're buying land, adding value, okay? A lot of people are guided by emotions. I see this all the time. Greed, fear, panic, FOMO, fear of missing out. I see this guiding people, and we are emotional about money. Money is an emotional subject for most of us. But if you're a good investor, does not get is not led by emotions. They're led purely by this makes sense, this doesn't make sense, by numbers and by location, by what you're investing into, right? Not emotions. Don't panic. I mean, I know this is easier said than done, but it's practice makes perfect. Don't let the fear of failure stop you. There are going to be, every investment you're going to make is not going to be the best investment, guaranteed, right? I haven't called 100% of my shots correct at all. I have failed and I have succeeded, and those I fail, I learn what not to do. What did I do wrong there? So correct. If you don't want to invest thinking you're going to be 100% successful in every freaking investment you make, it's not going to happen. Don't be stuck in your ideas. I'd say change. Again, something worked well in the last 10 years, great. Single family worked well, you made money, great. Don't be stuck in it. It's not going to be the same story going forward. You have to be willing to adapt to the markets, to the different cycles. Don't forget about taxes. A lot of people will say, oh, I made a lot of money. I'm like, how much did you make after taxes? Important. Don't time the market. You don't know. We don't know. We are in a high. We've been in a high for a while. Don't attempt to time the market to get in, whether it's stocks, real estate, anything. Just commit. Like if it's stocks, maybe your dollar cost averaging, it looks good right now. Put a little bit in every day or every week, whatever that looks like. Same thing with real estate. There's no real good time. There's good assets and bad assets to get into at a certain time, but there's no real way to time the market because we don't know the future. Past performance is also not indicative, as much as I love to say that everything which I've done in the last 10 years is going to replicate. It's not, but we just do our best guess, right? Okay. Coming to where you should invest, right? Marcus and Millichap recently did this economic forecast for 2022. I highly recommend you go check this out. It's on their website. It's called Marcus and Millichap. I put the credits here. And I thought this was a really nice pictorial view of all the different investments and what's doing well, what's not doing well. And guess what I like to do? I like to take the things which are not doing well because I see opportunities when there is negative growth. When there is problems, there are opportunities. When something is doing really well, there are less opportunities, right? So all this is doing really well on the left side. On the green side, self-storage, multifamily, affordable housing, single tenant retail, like if you had a grocery store, it's doing really well. Warehouses, obviously we live in an e-commerce world, warehouses are doing great. Life sciences and biotech is doing really well, given what's going on in the market right now with COVID. But here's all the things that are not doing so hot. I personally love senior housing. Again, this is not investment advice. You can do your own due diligence, medical offices. I don't see these things stopping ever, right? Like there are people getting old. There are people who are going to the doctors more so, right? So some of these are asset classes which are going through a temporary low, but they're going to be back up. And that's where I like to personally put my money. You have to be comfortable, like I said, when things are not going well, to go into something with your eyes wide open, because there is opportunity there. Like hotels, I don't know if you know, during COVID, hotels got trashed, right? People were scared, but it's also actually been on the rebound. People are going to travel again. We are going to live again past COVID, right? So you are looking at opportunities that will happen in the future, not just which have already been on the great side. That's not where your opportunity is. Some questions that I ask, people ask me all the time, so I just want to cover these before I open it up for questions. What guarantees do we provide? We don't use the word G. We don't provide any guarantees. There's projections based on these investments that we put money into. We project and we either meet projections, we underperform, overperform, whatever the case. We don't make any guarantees, right? This is not an FDIC insured investment. Can I invest with my retirement accounts? Yes, you may, but not directly with Fidelity or Vanguard. You have to move that to what's called a self-directed IRA or a solo 401k to invest into a real estate investment, which is very doable. And we work with investors all the time on this. What happens if cash flow is impacted due to adverse conditions? This happens all the time. It happened during COVID. We had to be prudent about distributing cash and withhold cash because we didn't know what was coming in front of us, right? If you were to go buy a house tomorrow and you don't know what the future looks like, you're going to start conserving cash because the cash is what will tide us through a bad market, right? So if we do that, then we catch up on the back end. It's always accrued. The money doesn't go away. We do pay the investors whatever they're due when the property is sold or refinanced. I need my money before hold period. I have an emergency. Can I do that? Real estate is an illiquid asset. You cannot take out your investment in these kind of assets, but there is always a but. Let's say I invested as an LLC and I want to add my friend to the LLC and transfer the interest of the LLC to a friend. I can do that even with or without an LLC. I can transfer my interest to someone else, but you don't know 2 years into the property what your interest is worth. Let's say you bought something for 50,000. 2 years later, you don't know what the valuation of the property is because we are in the middle of the hold period. So you have to figure out how comfortable you are doing that exchange of money before the hold period, and you have to find someone who will take your place. Do I need an LLC? You don't need an LLC. We have plethora of LLCs, but if you want to create an LLC, you can. It just provides an extra layer of security or asset protection for you, really. What happens if the market conditions are unfavorable at the end of the hold period? I tell you, hey, it's 2-year hold, market is trashed. I don't know, I can't see in the future. Market is trashed. What do? We tide over the market conditions. We see when it's favorable to sell the asset, we hold it out because what comes down should go up and the vice versa, right? So we always think that this is a long-term game. If the end of the hold period things are not favorable, we're just going to hang in there a little longer. What are the fees are paid to sponsors and general partners? Usually there's something called an acquisition fee. It's about 2 to 4%, depending on the asset. And then there's an ongoing asset fee or a development fee for new developments. Those are fees that we disclose. And all your returns are net of all the fees, right? They're after all the fees, that's the returns we specify. What's the worst that can happen in this kind of investment? You could lose the entire money. That's it. As an investor, that's the biggest risk you can take, but nobody can come after your other money, right? The worst you can happen is, yes, it can lose loss of principal, but it's our goal to never get into that situation where there's any kind of loss of principal, right? How do I do my own due diligence on this investment? I have a worksheet on my website, cherrystreetinvestments.com. I'll share the link with you. I have a due diligence worksheet. You can go download it, and then any investment you're making, it's tailored for multifamily, but it really doesn't matter. You can take some of those questions and use it for any kind of investment, which reminds me, I probably should create something for another kind of investment as well. It allows you to check off a lot of your due diligence items. There's a lot of due diligence you can do sitting right at home. You don't need to even go to the property, but if you can, that's a bonus. The returns you specify net of all the fees. Yes, it's net of all the fees. I like this one. This is something I always say, don't worry about missing the boat. There's another one coming. But the bigger question is, are you prepared to get on that boat? Are you prepared to take action, right? A lot of people want to do things, but they don't. And then they look back and they say, hey, I wish I had. So the question is, are you prepared to get on it today? All right, I'm going to open this up for questions and also share my information if you're interested. Questions? Let's see, no real questions here. That's surprising. All right, what is a min and max period for these types of investments? We could have a minimum of we try not to hold less than a year because then it triggers short-term capital gains. So we usually do more than a year. Typically, we'll have 2 to 5 years for investments. All right. The cap rate appears good for comparing performance between properties, but is it good for measuring performance over time? It can be good for measuring performance of the time. So let's say I buy a property at a certain cap rate, let's say 5 cap rate, right? But I increase the net operating income over a period of time, then my cap rate really goes up, right? As I buy the property, even though I buy it at 5 cap, I could be operating at a 7 cap. So it's actually a good way to see what the property was bought at and what cap rate you're functioning at. Although you could be selling at a lower cap, depending on what the market demands at that time, which is a good thing. Selling at a low cap is what we want. Do we have a wait list sort of if someone wants to cash out or lead the investment and a wait list can get on it? We don't have anything like that. We usually don't allow the in and out of an investment. You have to find your replacement investor when we do that. Do you take 506B or only 506C? We do both. You can reach out to me, go to cherrystreetinvestments.com, hit the invest button. There's a red invest button on the right and you can fill it out. You will get notified of new investment opportunities. Would you explain how an investor can capture depreciation while investing in a syndication? So we do that for you. When you guys invest into a syndication, we take and depreciate the entire asset. All right, we get a cost segregation company, we go through the whole exercise, and then we split out the depreciation through individual investors based on the investment amount or ownership percentage in the property. Minimum investment 75K because we have a lot of investors who are paying 75K. We also raise a lot more money. So let's say I'm doing a $10 million, $20 million raise. If I'm going to take 25K from each investor, it's going to take me that much longer to actually raise that money, right? So our investments are much larger than other investments. So let's say I'm raising 2 million, it's easier to take 25K. If I'm raising 10, it's many more investors are needed to raise that capital. So we do have investment minimums of 75K in most investments. Step up basis for 1031 to pass on to Kennedy, does it get taxed for kids? Sanjeev, you'd have to talk to CPA on that. As far as I know, the basis gets stepped up to whatever they inherit at. When you pass real estate to invest to kids, and I believe estates, anything above 11 million in assets gets taxed. Otherwise, there's no taxes. This is what I understand. Please consult your CPA on that. Is it a good time to invest now? Will there be a correction in real estate? Again, we've been waiting for a correction for the last 5 years, so I don't have a crystal ball. But what I do invest is assets which I know that will do well in the long haul. Like right now, I like land, I like senior living projects, I like new builds because we're able to build at, let's say 180,000 a unit and sell it at 250,000 a unit. So I believe that there's money to be made in every market. It just depends on the kind of asset you're investing into. What market do you recommend outside of Austin since it's super hot and not a good time to get in? I like a lot of the tertiary markets. There's Killeen, there's San Antonio. San Antonio has always been a favorite of mine. Taylor, there's so much growth going on outside. I mean, people buy in Marble Falls, people buy everywhere outside Austin right now. So just recommend that you look for cash flow when you buy into a property and just don't buy based on appreciation. What are the areas our sponsors focusing on? Oh my gosh, everywhere across the country, Midwest, North Carolina, South Carolina, Florida, Arizona is on fire, Georgia is on fire, Tennessee is on fire. There's just so many markets out there. Midwest generally tends to be more cash flow centric and not going to see as much equity growth in Midwest. When you come to markets in Texas, you're going to see a higher equity growth right now. So it just depends on, again, what you're after. I think I answered this one. Will there be a correction soon? There'll always be. I mean, I think the market is ripe for a correction. That doesn't stop me from investing. It just matters what kind of assets you're investing into. All right, cap rate answered this question. Step up in basis, we answered that question. Any other questions before we wrap up for today? Any questions personally that you want to hear about my investing journey, or otherwise I'm open? Do I expect to see more foreclosures soon? That's a good question. So what's happened in this market is that I personally, depending on the market, Texas, I don't expect a whole lot of foreclosures to the market. People have a ton of equity in the house. Why would they foreclose? Why can't they sell, right? We have to see a lot of homes on the market for there to be foreclosures. People should not be able to sell, and I just don't see that happening in a growth area like Texas, for example, where people are moving in constantly. There isn't enough housing in Texas right now. So unless the jobs go away from Texas, I don't really see how that could happen. Is it a one-woman show, or do you have a group of investors? It's not a one-woman show. I have partners. I have people that I work with on all my investments. We usually a team of 4 or 5, depending on the investment. I have partners who specialize in land. I have partners who do multifamily. I have partners who are in senior living. So it's not a one-woman show. I couldn't pull this off by myself. For 1031 exchanges, we have done a few 1031 exchange properties. We do demand $500,000 there because it's a pain to do a 1031 exchange. We try to move, get a pool of investors and do only 1031 exchanges. So we had so much trouble with that I'm not interested in as much in doing syndications and 1031 exchange. Can I explain what I'm doing in senior living? That's a good question. So we have a piece of land. We actually did like 2 new construction senior living projects. So one of the things that's happening in the senior living world is that it's just growing, right? Like there's a need for senior living just coming from the baby boomer generation, which is 70 million plus people. And there is going to be this need the next 20 years, right? So what we are doing is we're buying land right now. We're looking at building senior living, getting into more senior living projects, and then moving that, maybe potentially selling that property at the end of the stabilization, or maybe moving it into another fund where we cash flow on these investments and just generate 12% returns for investors, or whatever the cash flow, good cash flow looks like. So I do believe there's a lot of runway in the senior living space that we haven't explored yet. Same with medical offices, just steady eddy cash flow, nothing crazy. You're not going to see it out there, but it's just going to be a long haul investment. What has been your best internal rate of return? We actually did about 66% on a project in Phoenix. Again, past performance is not indicator of future success, right? 66% a year for 2 years. We just did a 2-year hold on a Phoenix investment. It was great for our investors, great for us. But again, this happens in a market that is going crazy. Like we put our 2 cents in to add value and all of that stuff, but the market did the rest also. So I can't really claim that we did it all, right? It's great that the market cooperates with us, but the goal is that even when the market's not cooperating, you still don't lose the money, don't lose your shirt, right? Give a nominal interest rate of return, but tide through any market craziness. Currently, I don't have any investments. We had an investment open for a land opportunity, and we're having a couple more coming up soon. It'll be a land entitlement play. We buy land, we entitle land, and we sell land. Can W2 income investors take advantage of depreciation in apartment investments? Golden question. Yes and no, not directly, but if your spouse is a real estate investor for tax purposes, or you are a real estate investor for tax purposes, yes, you can. Please talk to your CPA. Also have a webinar on this that my accountant, my CPA did, called Real Estate Professional for Tax Purposes, or something of that sort. If you're interested, you can look it up under the webinars. Investments we have currently open, nothing right now. I'm just talking about what you can potentially do in real estate. We'll have land, we'll have senior living this year. We'll have some apartments too, just depending on what comes up and what makes sense from a numbers perspective. If there is a break in employment, will they badly affect getting a loan? Might not to talk to so if you're doing these kind of investment with us, we don't look at your loan and your credit. You don't get to participate or put your credit on the line. If you're going to go buy a house by yourself, then it matters. So we do talk to our loan officer if you're trying to buy your own house. If it's a syndication, we don't care about your break in employment. I hope that answers all your questions. Am I into vacation home and rentals too? I am not into vacation homes. That's one too many things for me to do. That said, I do believe there's a huge opportunity in short-term rentals if you're willing to put in the time, especially from a tax breaks perspective. Definitely investigate that. There is a lot of opportunity for you to save taxes on your W-2 income if you're participating in short-term rentals. Thank you everyone for joining in. Again, if you're interested in investing with us, you can go to Cherry Street Investments, hit the invest button, sign up, and we will send any future opportunities which will be coming up soon to you. Thank you again and have a wonderful evening. Thanks for staying with me through this boring presentation, but hopefully this was informative and you got something out of it. If you would drop me a line, let me know how I can do better. I would love to help you guys, help you learn and know more real estate stuff. Thank you. Have a great evening. Hi, I'm Kavita Bartake. I hope you found this video useful, and if you did, please don't forget to subscribe to my channel so you can get notified of any future videos I upload. I plan to cover a lot of investor education on this channel, and I hope you'll stay with me for it. If you have any feedback on future content you'd like to see me cover, please drop me a note or a comment on my video. Thank you for watching, and thank you for supporting me.